So thank you all guys for coming along. Adelaide's something that for someone who might know me would know that I'll ramp on quite a bit about it. But I think across Australia, there's really not a lot of people talking about it. And I think there's a lot of opportunities there that a lot of other investors might have overlooked, and it'd be good to get ahead of now. So to give you a bit of an Adelaide intro, for those, I'm sure most of you know about Adelaide. Adelaide is the 5th largest city in Adelaide. We've cracked a bit over 1.3 million this year. We're trending on nicely. We've traditionally had quite a slow and steady growth rate in population. Growth is incredibly important for any property investor. That's where you see the markets such as Melbourne, which go quite strong from their population growth, and likewise we see the inverse with our regional centres where some may be stagnant or declining, and we see a similar trend in property prices. With Adelaide, we've got a really great standard of living, both on national and global indexes, which show that we're ranking there for the low cost of living, the high standard of living, and just low property prices, which are making it affordable for families to still get into the market. Whereas in the East Coast, where we still start seeing these arguments about property bubbles and the like, which are precluding some younger people from really getting into that marketplace. Adelaide at the same time still has a very healthy rental market and has some of the highest yields in the countries. Arguably in mainland city capitals, we're seeing the highest yields. Hobart, if you were to conclude across Australia, would be the only state capital which does actually go above Adelaide in terms of yield. About precision funding, it's always good to know who you're actually listening to, so you can know where we're sitting with things and what we know and how we do it. Precision Funding is a boutique investment focused mortgage broking firm. We really help people on strategic investment lending advice. So we help those people who are trying to build those large portfolios. So for doing a strategic portfolio, you can generally increase your borrowing capacity by at least 1.9 to 2.5 times just through a holistic approach of finance. Generally, we do both residential, commercial and business finance. We also dabble in the financial advice, self-managed super funds for our private wealth division. That's myself there. I'm the presenter, Batt. I should have had a shave the day that I took that photo, and my wife picks on me because of it, but that's fine. You would generally find if you ever came into the office, I'm pretty rare to get shaved properly. Market statistics. We're going to go through two different sections tonight. We're going to go through those normal macro statistics which you can find on the internet and through every other data source, but we're also going to go through statistics which are generated through our particular brand. We keep a lot of macro data of clients and we scrub all that information so you can see the important statistics about where are the trends of where people are buying, why are they buying, how much are these sort of purchases looking at, and we're seeing some very consistent trends which do change year on year. I think that really talks a lot about what's happening in the market and where things are happening in the market as well. But first we'll go on with the market statistics, just from the core data such as CoreLogic. So for those who are familiar with Adelaide, probably seen this chart before. It's one which a lot of Adelaide people are really fond of at the moment. But one of the recent RP data CoreLogic graphs which show the mainland capitals has actually shown Adelaide for year on year have come up 6.5% growth over the last 12 months. Adelaide historically gets quite a bashing in terms of capital growth, but when we look at the statistics, we actually do still find that there is consistent growth, just not at that stellar rate that you sometimes see the eastern suburbs, eastern states such as your Sydney and Melbourne, which can go through quite exceptional short-term growth and have corrections and boom and bust over time. Adelaide's generally a performer which you'll see perform consistently year on year. It does have its upticks and its downticks, which I'll show you on the next page. But overall, it's a nice steady growth along with steady rental increases over time, which generally are going ahead of CPI, which is always important from an investor's perspective. In terms of Adelaide Metro median price, I think this one always tells a fantastic story. This is the 10 years mark of median prices. It's from the state government. They release these every quarter. What you'll see here is 2006. Adelaide experienced quite a steady boom right on to 2009. During that period, some houses doubled, some were only around growth of around 40%, but in any case, it was quite stellar growth. This was comparable to the current Sydney boom in terms of the local discourse of the time. We were seeing a lot of people pushing into the market, trying to get in. I think it was going to be the boom of all booms. rightly, once the market did hit its peak, peaking around that late 2009 to 2010 period, we did see a considerable correction. This was in line with the GFC in full swing, and we did see the Adelaide prices moderate and take quite considerable declines over a 2-year period. Now, what we're seeing in that time is some areas were dropping by 20%, and it's not uncommon today to actually still make purchases where you'll see the previous sale price was higher than it currently is today. That did spook a lot of people, and it created a self-perpetuating motion between investors where they're looking at that 1 to 3 year growth and seeing it heavily negative and asking, what's the growth like in Adelaide if that's the case? When you look at it from a long-term perspective, you see that it does have some strong growth periods. There are some slow periods. What we've seen since 2010 is what's been called a recovery period. The actual founder of Residex, we had a discussion previously just last week about this recovery period, and he believes this period is edging in towards a boom period, which I find quite interesting. I do think that there is a lot of capacity in the market for growth. We see that consistently with people in terms of their cash availability, their borrowing capacity and their needs. But at the same time, I don't think we're going to see a similar boom level to that 2006 onward time, which was quite astronomical in some places, doubling in their values. The precision statistics, this is something I really wanted to show everyone here. This is something which will give you an insight into suburbs, but also areas. In terms of areas, Adelaide historically has its northern region, its south, its east, its west, but we also have what we try to segment as northeast. It clutches between the more affordable, lower socioeconomic areas of the northern, outer northern regions, and straddles between the eastern region, which is most known as the highest value, highest median, highest income area of Adelaide. So it gives a very blended mix of values, yields, and the type of demographics in there. But initially what we're going to do is I'll take you through to the suburbs. What we've done is since 2014, we've actually been collating the top suburb purchases year on year for our clients. To give you an idea, we've got about 800 clients on the books, and they are spread across Australia, but these are just the Adelaide-related metropolitan area purchases. What we've done is looked at not in terms of dollar value, but in terms of sheer volume of purchases within a suburb and ranked them from highest to lowest, and we've taken that top 5. What that gives us is shows you where investors are looking, where they're committing to purchases, and where the trend is year on year on year. So what you'll see here in 2014, when we're still going through that recovery period, you're seeing a heavy push towards high yielding investments. Interest rates in that time were a lot higher than they obviously currently are, and we're seeing continual slide in rates. But so people were really looking for those high yields to get into those investments. Prices were still coming off quite low areas. So for instance, in Elizabeth Park, I myself have invested in there. Many investors have pushed into that area, and you could buy properties into the, say, 130s, 140s for a freestanding developable block home, and the yields were between 8 and 10%. That caused quite a considerable amount of demand, which in turn has now pushed the prices up. Rent has increased during that time, but not to the level that the growth in the capital values have. So we're seeing that yield now starting to creep down, which I feel is moderating people away from those markets and looking at other markets. So Elizabeth Park, the Smithfield Plains areas, they're the areas which you can find some of the highest yields in Adelaide at the time and some of the highest in the nation. The areas below, such as your Paralowies, your Parafield Gardens, your Ingle Farms, they're within what's known as the Salisbury Council LGA. The Salisbury Council is directly below those cash flow areas of Playford Council, but they still offer yields which are reasonable, but had higher owner-occupied demographics, some development potential, a lot more difficult to find. I know some of our listeners have actually found developable blocks in there, and that's fantastic because they are really getting difficult to find now at reasonable prices. You'll find the great trend about this is if you look through these years, you'll see that there are some upticks in areas and some downticks in areas. The star performer, I would say, of all the data across this is the Ingle Farm area. You'll see 2014 was in the top 5, which is still outstanding. To give you an idea, I believe just off the top of my head, there was still around 25 purchases in that year alone. Going through, you see that Ingle Farm has just gained in popularity. right now, 2016, it looks to be the #1 performer, and I really won't be surprised if that stays in that #1 position. We're only 6 months into the year, but I think into the financial year, that'll probably stay in that position there. Capital values in that time, in 2014, it was possible to purchase as low as 250,000 for a property there. Now you're edging up into the low 300s. It is still possible to get into that high 290s range, but it is incredibly competitive compared to markets where we're seeing in 2014, where you could effectively go to an open by yourself, place an offer and be the only person buying. Now with properties there, you're looking at 10 to 20 people going to the first open, competitive offers. You're really needing to put unconditional offers a lot of the time just to secure the property, and you're going to need very favourable terms. Other areas have started to fall off. Like I've said, I feel the Elizabeth Parks and the Smithfields have had their day, but we have seen a significant drop off. There are still investors buying in there, but they are looking at alternative areas now, looking more towards that balance of capital growth and cash flow, looking at areas which may be closer towards the CBD to balance their portfolios, which already have those strong cash flow properties in them. There's other areas which you'll see which have come on and dropped off, such as Para Hills, Windsor Gardens. These areas are adjacent to some of the more popular areas now. So Para Hills, for instance, is directly adjacent to Ingle Farm. And we've seen, as time has gone on, that people are looking at those next door areas to then say Ingle Farm, because competition, they can go for that place which may not have the same brand recognition, that suburb recognition, but has the same council policies for development and maybe slightly cheaper. So then they can get in there and ride off that continual growth as people are priced out of one market and then move into the next. In terms of the areas, the vast majority of those listed are cash flow areas, but I wouldn't say that the majority of clients and majority of investors are chasing cash flow. Adelaide does have a strong market and a strong desirability for cash flow properties, and people looking at cash flow properties think of Adelaide. But what you'll find is that the areas where there are cash flow properties are some of the largest geographically and number of houses within that area. So I believe Parallel, for instance, is the largest suburb in Adelaide in terms of number of houses, compared to your inner suburbs or your growth areas, which may be as little as 20% of the size of that. So whilst you will see a large number of cash flow areas in these top rankings, it just means that due to the sheer number of properties available, it's just not possible for an area with 400 houses to compete on the area with 2,500 houses in terms of purchases. In terms of splits, we are seeing around a 60-40 split. 60% are going for the cash flow, and that remaining 40% are looking either at development stock, at your inner ring properties, or maybe those blended neutral properties which provide both not having to be heavily negatively geared to hold, but also having that upside of capital growth with the desirability factors being adjacent to those areas which have had very stellar growth and pricing people out. If anyone does have any questions, you'll see on the right there is the chat, and you can place things in there. We will be utilising that in a little bit, but if you do have anything, put it in there. When we've got the chance, we'll definitely try to answer it. We will actually give you a chance a little bit later to ask about areas you like, and we'll pick a few of them, and we can go through the pros, cons, and what we're really seeing there. This is my favourite statistic. So this one's actually run on the financial years of July 1st to June 30. You'll see the previous financial year and the half year currently up to date. What you'll see is each of these sections by north, northeast, south, west, east, and the CBD. We have kept that in there just because it is something which investors do consider, and we can go into the pros and cons of that later. But what we've done is segmented that on where are investors buying on a per property basis. So some investors have bought in all of those areas, some have bought in only one. But in general, you'll see in the previous financial year, the vast swath of the pie did go towards the northern suburbs. Secondary, the southern suburbs did follow in, and that's really unsurprising because in terms of those areas, that is where the bulk of property and the bulk of the population is, and it's also where the bulk of your cash flow and your balanced properties can be found. So those outer northern regions, such as the Elizabeth Parks and the Smithfields, are found in that northern area. But likewise, Ingle Farm is, which is more of a balanced play, which has development potential now. Down south is where you have your Christie's Downs, your Morford Vales, but you can also go as right into the inner rings, such as your Unley properties, which are 4 to 5 times the median of those outer areas. The vast majority of them are in that middle to outer ring currently. But as you'll see in the next graph, that is starting to change. Just quickly, you'll see that the eastern suburbs in FY15 to 16 financial year still has a very small grasp of the investor market. The reason for this is that it's a majority owner-occupied area. It does have demographics which have desirability to buy in that area. It's very popular with the Chinese, Malaysian, Singapore communities. There is a very popular international school which is located within that, and that's driven huge growth in prices. Some areas are up 20% over the last 18 months. Because of that, it doesn't attract a lot of investors. When you're looking at $800,000-$900,000 properties with sub 3% yields, it's very difficult to sustain or justify that as an investment compared to alternatives. We do still get people who buy in there, but they do make a minority in comparison. What you'll find is most of that 5% would actually be townhouse stock, because whilst there is a little bit of infill development, the councils in that area for the most part are anti-development, and you'll find that there's maybe a few 80s and 90s or early 2000s built properties, and they're looking for that almost balanced yields in those really desirable inner suburb areas. Going into from July 1st to the current date, that statistic is actually, it's current as yesterday. We updated that just finally. You'll see that that outer northern area has really shrunk quite considerably, and it's been redirected to the west and the northeast. The southern region still maintains for the most part its same amount of desirability. The eastern suburbs have contracted slightly, and the CBD is really sitting where it was since the start. The northeast and the west are really growing this time, both in capital growth but desirability, which is driving that growth, just because people are looking at the west, which traditionally has had some of the lowest median prices and the lowest rental returns comparative for the inner suburbs. It previously had high housing trust numbers, same with the northeast, which had a lot of housing trust built stock, which is not surprising in Adelaide. In the 1960s, most of the growth in properties in that time, in terms of being built and constructed and land being released, was actually driven by the state government. We had a state government which built out large amount of houses to create low-cost housing, which in turn allowed people to build factories and like here, which could provide cheaper comparative wages to every other state because the cost of living was so low. That's flowed through to today. It doesn't happen anymore. The state government isn't building more properties, and they haven't for over 3 decades now, but we're just seeing that lasting effects go through the system now. With that in effect, these houses generally are lower quality construction, and that's where we're seeing the northeast in particular is being redeveloped, it's being renovated, and that gentrification is starting to come online to meet the needs of the 21st century. The western suburbs, on the other hand, the inner suburbs for the most of it, are filled with, to be honest, quite beautiful character homes, which are priced considerably lower than their north, east and southern equivalents. People are now driving towards that area because the south prices, the inner north prices and the east prices have grown up so dramatically. It's applying that pressure for those who are looking for quality character homes. You're going to hear me say character homes quite a bit. Adelaide has a strong fixation with heritage property, character property. These don't mean they're actually listed as heritage property and you have to maintain certain guidelines, but it means they're generally the double brick, stone fronted bungalows, villas and the like, which are a general sign of wealth and desirability. There's just such a small finite number of them left that people will pay excessive rents, excessive value to be able to get into those properties. And that's where we're seeing strong drivers for that western suburbs, which you're having the older houses, which was developed in the 1800s to the early 1900s, flowing right through onwards to your Torrensvilles, your Flinders Park and the like, which still have a lot of bungalows and 1920s homes, right through to your austerity and your Art Deco homes. There's a really nice mix of property in the area that you can choose from, and we're seeing that happen now with the gentrification. Meanwhile, your north and your south, they're still growing, they're still showing a lot of investor activity, and they still have the bulk of it, but they just aren't having that vast majority domination of the investor market as people start looking at other areas around. One of the other things that I think which are really shifting people is mood to other areas, particularly that middle ring, is the affordability factor. When you're looking at interest rates, which have now declined from the 7% range, below 4% for many investors, that's made it affordable now for the average investor to be able to hold that property which they may have otherwise not been able to in the middle ring. They can buy a property which may have a sub 5% yield and be close to neutral. They don't have to fish for that 8 to 9% yield to keep their affordability strong and to be able to meet their own commitments. The other main area which we should really talk about is the CBD. Much like every other mainland capital CBD, there is a transition to high density living. Adelaide is very much behind the times. In terms of that, we still have single-story freestanding homes in the CBD. They are worth quite a large amount, but at the same time, there is still a large suburb section of it still available. We do have a large amount of apartment construction underway, just like every other capital, and we also have a large oversupply of apartments too. In general terms, I would be avoiding apartment stock in the CBD if possible. I will go into this a little bit later, but to give you an idea, currently we've got an oversupply estimate of around 2,000 apartments in the Adelaide CBD. To give you perspective, there's only 18,000 people living in the CBD itself. It transitions with student population like to a little over 23,000, but it's almost 1 in 11 apartment, for every 1 in 11 people, there is a vacant apartment sitting there at this time, and construction is booming. So there is a lot of supply available now which needs to be absorbed. The other concern comes into place is that we're having a large redevelopment of the Royal Adelaide Hospital, which is being proposed. The hospital is being moved to the western side, which is another driver for the inner western suburbs. The site, which currently sits next to the edge of the CBD, is now looking to be redeveloped into apartments. Likewise, to the southeastern region of the CBD, we've got the Glenside Mental Hospital, which is now being constructed into apartments and townhouse stock as well. Between those two sites, there's almost 1,700 more apartments coming online over the next few years. It would likely take over a decade for them to come online, but that is a lot of stock coming into an area where there is already a lot of supply on market. So be very careful about buying apartments. It doesn't mean they can't make great investments. It just means that there is a lot of factors that you need to weigh up before making those purchases. Opportunities for 2017 onwards. These are really the 3 main areas which I would suggest that people are looking at, and it covers what most people look at for property investing. But there are some great perspectives that Adelaide can offer all of those in comparison to other states and other cities, which may be where they are in terms of the cycle, the property cycle, may find it difficult to be entering into, say, a cash flow property. To go through those, the cash flow properties, they still remain a really strong part and parcel part of anyone investing in Adelaide. Adelaide would be the #1 metro area in mainland Australia where you can still find strong cash flow opportunities. They do float between that 6 to 9% yield in certain areas. That 9% range, you'd be looking at areas such as Davern Park in the far north, arguably the worst suburb in Adelaide. It does have a large amount of stigma to it. It also has a large section which has been designated to be redeveloped and developed for the future into subdivisions, townhouse, high density living. Whether or not the numbers stack up right now, generally not. The land values for post-developed stock are so low because most first home buyers can choose to live in other areas. Affordability is incredibly strong, so there's not much driving the owner-occupied market in that area, and that's where historically Davern Park has been 70% investor. There's a very small amount of owner-occupiers, and most of that owner-occupiers bought their houses from the state government quite a number of years ago, and we're seeing that change hands down as they go into retirement phase. So it is a bit of a concern, the number of investors there. Generally, you're really wanting to see either a stable or a growing owner-occupied demographic in a suburb if you're investing there. In the end, investors buy because the numbers work. Owner-occupiers drive emotional demand and growth in prices. Desirability as it increases is what's going to give you that capital growth over the long term. If you're buying at a really high yield, yes, you may be able to consider a lower cash capital gain perspective, but you still want to have something there to take up the inflation which you are receiving. Otherwise, after cost, you may not be going anywhere in terms of it as an investment, and it's not getting you closer to your investment goals. To give you a perspective, the bottom left-hand corner, that's a house in Paralawi. That would be arguably one of the best places to get both a mix of cash flow with a little bit of capital growth mixed into it. You can get yields upwards of, say, 6, the high 6s, maybe as high as the 7% range, but you still have a strong historical growth rate there. The owner-occupied rate there's 80%, which is above the national average, and you do see it in the area where many people are renovating. They're keeping it up in trend, and there is a small amount of infill development happening there with old parts of semi-agricultural land, where house and land packages are around 50 to 60% above the current median price. So those drivers there are really there for the future, because people who can't afford that nice new home are now looking at the established stock and saying maybe that's something we can afford. And agents that we speak to and market regularly are saying that they are considering their options and they're seeing it as an affordable option to own a large block with all the amenities that they need, and relatively modern, because most of the area was started being developed in the 70s, but the vast amount of stock was built in that 90s and ended around the 2000s. Affordable blue chip buying. If you're looking in Adelaide right now, city adjacent, you have around the Mile End in that inner western region, but for the most part, the inner north, south and east are prohibitively expensive for a freestanding home. These areas are some of the most expensive in the area. You may find some are as low as the 8 to 900s, but they can go up to 4 to 5 million. Values do hold well there, and yields aren't exceptionally strong because the growth keeps growing at a rate faster than the affordability of rents. So if you are looking at that range, maybe it very well might be an option, but you'll find most investors are looking at that suburbs next door, because there is a considerable drop off in value once you go beyond those areas such as Unley, Norwood, etc. So if you look towards that inner to middle ring, and this is within 5 kilometres of the CBD, is that you can find properties which are in that 5 to 600 range. You may be in the low 600,000s, but you could be within 4 to 5 minutes of the CBD. Yields are around that 4% range. If you do mix this in with a strategy such as renovating, you may be able to get very close to a neutral yield in the current rate environment, whilst also being in a high capital growth area. A great example of this 12 months ago, which I've written about previously, was the Nailsworth area, which I would encourage people to look up. It's in the inner northern region, directly adjacent to Prospect. It was a 5-minute drive to the CBD. That area experienced 20% growth quite recently. You go to auctions, which were previously going for the low 500s, 520, 530. They would now be listed at 550 and selling at 650. That sort of growth has been quite considerable because people have been priced out of the adjacent regions, such as Prospect, moving directly over. I've actually personally looked to invest in there and had exact people state that the number one reason they were there was because they tried to get into that adjacent suburb and just couldn't afford it. That affordability is now pushing onwards. So to give you a perspective there, instead of Nailsworth, they're now looking at the suburbs next door. These are very small suburbs, 10, 20 streets, but they look to the suburbs next door and the prices then flow on accordingly. So that's where the affordable blue chip buying style really works. Great example in that middle picture there is Californian bungalow. That's the main style stock that you'll see in these middle regions, because they were developed in the early 1900s, the 1920s, where that was the predominant style. We then went into the austerity style and the like, and the Art Deco for a brief period, but that's where you'll see the majority of that stock. The yields are negative, not overly, except for the eastern suburbs, which you have to be very careful of matching up what the growth has already achieved, what are the yields now, and whether there's a safer play to look at. The third option, which still remains a great option in Adelaide, is creative development. By creative development, I have to state Adelaide is one of the best places to find an easy development. I wouldn't say it's one of the best places to find a profitable development. In South Australia, the ability to subdivide land is so easy that in 2006, the average block size was 650 square metres across the metropolitan Adelaide. That block size now is 375 square metres. It's almost halved because so many blocks in the area have been subdivided in half, and then they build duplexes. They do build a lot of detached homes because a lot of these blocks are usually 20 to 22 metres wide, symmetrical rectangular blocks, 600 to 700 square metres. So the average person now is buying a 300 square metre block and building a 3-bedroom, 2-bathroom single garage home. That's very, very common. The problem with something being very common and very accessible and very easy, because a development like a subdivision, in terms of government charges, by the time you build the infrastructure, knock down the home and pay for all charges and end up with 2 blocks, it'll cost you as little as $30,000. So these council contributions are minute. The cost to duplicate the facilities, the infrastructure, the water, electricity and stormwater is not incredibly expensive. It can be if you don't have a very well positioned block or it's a large block, but overall it's not expensive. And what that is meaning is that people can buy into that, which may not have huge affordability. You're getting the mum and dad investor, you're getting the first time developer, and it's incredibly common, the owner occupier who thinks they can make a quick buck by cutting their house in half. What that has resulted in is that, for example, a house which sells for $400,000, which can be subdivided, the end value of those blocks may be $400,000 itself. So by the time you demolish and pay for those charges, you're losing money. That's just because people aren't making the right research and they're not working out, and they're generally buying to develop in the future, accepting that it's not profitable now. If you're looking for profitability early, you're going to need to look at those creative sites. That's your corner block divisions where you may have an 800 square metre block and you can put the side access in there. I would shy away from rear hammerhead style or battle axe style, depending on the terminology of your state. Those sort of developments, they're not incredibly common or popular in Adelaide. The capital value of it post valuation is incredibly low, so you generally don't have a very high return on investment. The corner blocks do retain quite well because they still have that traditional street frontage, which is popular in Adelaide. The great value which you can derive is looking at that 3+ development site style property. That's generally your townhouse. Sometimes it will be a triplex, single story house style development. That's where you're going to get value. A lot of it is due to finance, because with finance for 3+ developments, there is a limited number of lenders who will look at it. You still can get traditional residential lending, but for the mum and dad, owner, occupier, or investor, they may be precluded from being able to invest like that. So it's a great idea to look at that and look for those options which are available to you as an investor who is informed, which may be overlooked by most of the population. That style of development as well is becoming increasingly popular, and the state government is encouraging it, and as is local government, because our population is expanding. But as per recent legislation which has gone through the state government, they are now looking to cap the entire metropolitan of Adelaide to not allow further expansion of the suburbs. They do not want further sprawl, and they want infill development to grow and fill in most of that population need in the future. So we're not looking at more greenfield, large suburbs being developed, which has traditionally kept Adelaide prices affordable. And the main people pushing against that argument were people saying that housing affordability is becoming incredibly tight and incredibly difficult if this goes through. That is where we're sitting now. That is what we're looking at. So whether there is an option that you can work with which maybe make your profitable development work better, that's something to look at. Likewise, that means buying those sites or buying the property now, which is on a good sized block, may become increasingly desirable as people move towards that townhouse living or smaller block living. There is a large desirability to be on that larger house block, such as the first example of the Paralari property, which might still be 600 square metres. It may not be subdividable due to the block size, but there's a premium there because it's one of the few blocks left in Adelaide which can fit a shed, a swing set for the children, and a large driveway. So that's just something to really keep in mind, what's happening in the future, because Adelaide isn't static, just like every other market isn't static. Play with what's happening in the times, and what the policies that the government put in really do determine how your investment's going to play in the future. That, in my opinion, putting in that cap is going to create a bit of a pressure cooker there, which they're going to need to alleviate with development, and we've been growing that. It would be very interesting to see how the government and how prices react to that. What to avoid? I've gone into the first step quite a bit. Don't develop for developing's sake. Be very careful to do your numbers. You don't want to subdivide a straight and half block and come out negative $40,000. That's not an investment worth making. That's not an investment you want to do, and it doesn't get you closer to your goals, to retirement, to achieving what you need to do. You can still make money on dividing into two. You need to be creative with it. You may need to be very fast with your offers, but for the most part, it is becoming the rarity as opposed to the norm, because capital is available right now. It is very cheap and it's very easy to do that type of development. The areas with oversupply issues is the other main area that I would be suggesting people avoid. So oversupply is, in general terms, supply and demand determines property price growth. If you have 10 people fighting over one property, that property will sell for a premium, just as if you have 10 properties and only one buyer, they're going to keep dropping their price until that one person accepts one person's price. What you're going to want to do is to look for areas which have strong demand, and demand which will be there for the future and increase with time. If you look at areas with oversupply issues, there's two types: land oversupply, or B, stock oversupply, aka apartments or townhouses. Land oversupply is primarily in the far north and down far south. The eastern side of Adelaide is straddled by the foothills, and that's where I actually live. You will not be able to develop if you could, and it would be incredibly expensive. It would not be financially viable to increase the amount of population in that inner ring there of that things. You will see people right down far in Mount Barker, but some people would argue that's not even part of metropolitan Adelaide. Down south is where you're seeing the Seaford Meadows developments and the like, and it keeps sprawling out. To the north is where you see the Manapara West, the Manapara in general, and Andrews Farm. That would be the ideal case example of oversupply. There is a large amount of land which is growing. That land is going to be capped off. If you buy there and you buy well, you may very well do well from it. You need to buy well though. You don't want to buy just a general house and land package in those areas now, just because they are releasing thousands of blocks. They are being taken up, and it's very popular for first home buyers, particularly with the way the first homeowners grant works in South Australia. They get $15,000 if they build a house and land package. They receive no benefit whatsoever buying established stock. So you see a lot of people pushing in towards that for that cheap affordability and low deposits, getting people on. The downside for that means is there's always more houses coming online, and generally at similar prices. So if you have a similar price new property where they can choose all their features, fixtures and the like, or a 2 or 3 year old property down the street, the first home buyer has a financial incentive and a personal emotional incentive to be able to pick their property and benefit from it financially by effectively maybe half to 75% of their deposit already covered for some of these low value places, which may be house and land packages as low as $200,000. So in those areas, you're going to see quite a long time before all of that land is saturated and absorbed. There is caps towards the northern region of that because it is the food bowl of Adelaide. It is a large amount of agriculture which happens up there, and because of the water table, they don't want to expand the land further out there because it will actually devastate the economic benefits in the area. So the council is trying to limit that, and likewise the new state government plans to cap the boundary have done the exact same thing. So you're getting consensus across the government levels to not develop further up there. There is still time before that's going to be filled out, and there may very well be better investments in other areas, even adjacent areas such as the Smithfield Plains and the Elizabeths and the like, which is directly next to it, to those areas, but are established. They cannot put more land out. They can be developed and gentrified further, but that extra 10 to 20 minutes out north, people will go towards the facilities and the experiences and what they can gain within those areas which already exist and have exceedingly high yields. The third is something that I've already talked about a little bit, which I'm very much against wherever possible: apartments. As someone who works in finance, I can tell you that a number of banks completely now do not finance apartments in CBDs across metropolitan capitals in Australia. They definitely don't do it in a lot of suburbs across Australia. There is an increase towards this. You're getting LVR restrictions, you're getting suburb restrictions, you're getting endless restrictions put in place because banks are now seeing them as a risky investment. And when your bank is looking at it from a risk perspective, that means that they feel that the capital value is likely or very possibly can decrease, and they don't find it a safe asset to hold. So when a bank looks at it from that perspective, you have to ask, what are they seeing? And when generally they will take quite a lot of assets, they will still take assets in regional Australia, which may have marginal to no growth or maybe slightly negative growth, but they do look at apartments as arguably the most highest risk type of property out of houses, townhouses, apartments and the like. Subset of that is serviced apartments and student accommodation, which I would avoid with the plague, just because they do have even further restrictions on it with the lenders which do look at apartments and CBD locations now. The issue with apartments where you're seeing that the values not growing or very likely decreasing is very similar to the land argument, which was just spoken about before. What we're seeing is that there is increasing supply with developers which are looking to push large amounts of stock on there. The ability to turn a profit is increased dramatically by putting more dense apartments in a very tight location. So what that sees is there is no interest in maintaining values in the area, only as long as they can sell their stock. Due to the way that apartments are sold initially by developers, it forces a lot of people to continue with a purchase even if their value has decreased. So what we do then is we see apartments which are forcing people to buy into them whether they like it or not, and that's how they keep going. Traditionally, a lot of this apartment growth and a lot of this apartment construction was funded from overseas investors, which earlier this year have now been targeted, and for the most part are finding it very difficult, if not impossible, to gain finance. There is no mainstream source in Australia which will now fund an overseas Chinese investor to buy apartments in Australia, when there was half a dozen lenders which would happily line up and took quite a large amount of business in this space. Developers now are responding by going broke in some cases, are having to resell their apartments and the like, and this just means price discounting. When new apartments are selling next door to you for less than you paid, your value does increase accordingly. So do avoid that. That's not something you want to be holding on to. If you're looking at a long-term strategy of growing your wealth, just like anyone else, yield may be semi-strong, but with the rising cost of strata, apartments now are including a lot more facilities than they previously did. They have gyms, they have pools, they have cinemas. It's getting quite crazy. That's meaning that strata costs are rising dramatically. They may not even state that initially, but they are coming on. Adelaide economy. The great thing to talk about the Adelaide economy is what is happening with unemployment. Unemployment is the main concern of most people who look at Adelaide, and the number one word which gets brought up after the word unemployment is holdings. Unemployment, as of last month, has dropped down to 6.7 from the peak of 7.2%. It did rise to that level, which was quite considerably high and one of the highest times in 14 years. But historically, over the long-term period of the last 40 years, is not exceptionally high and represents a slight increase compared to other states. We've had a consistent issue of long-term intergenerational unemployment in especially the outer northern regions, where we'll see that while there may be strong job growth available within the area, we're seeing people drive into those areas to work and then move out, whilst locals may have unemployment rates of up to 20%. It's a systemic issue which needs to be worked with, but for the most part is not having the same drag when they're in affordable housing, and paying consistent rents. So that's something to keep in mind if you are buying in those cash flow areas. That may be your tenant type of demographic. I do have a number of tenants which are on Centrelink. They are some of the most consistent payers that I have. With regards to holdings, it's a very important consideration. Whenever you're buying an area, you're looking at what is the jobs within the area. You're looking at what's happening in the local economy. Holdings is absolutely closing down. That's going to happen. It's going to happen likely in the second half of 2017. They haven't announced the exact date and no one quite knows. They are winding down the number of staff at the site, but it will eventually reach zero. What I like to bring up is that the peak number of workers at the Holdens factory in Elizabeth was over 7,000 in the 2000s. I believe it peaked around 2004, and they've consistently reduced the number of staff since. Currently, there's less than 1,100. It's not quite easy to calibrate what it is. It was just a touch over 1,000 quite recently. That number of workers during that time, the market has increased quite considerably, even with the laying off that staff. As a percentage of employed people in Adelaide, they're not incredibly high. What you'll find is that these workers, in the large part, and I do have quite a number of Holden staff, and I wouldn't be surprised if there's even a Holden person listening to this, is that they do receive quite considerable payouts for the most part, and they're already having strategies in place. I also have family which work within Holdens, and they're getting degrees paid for them to retrain to become teachers to fill in areas which they otherwise couldn't. So there is a lot of reskilling coming in. Adelaide is going to shed industrial jobs. We have some of the highest, if not the highest, I believe, industrial job percentage in Australia. We have seen that consistently slide. It's now less than half of its previous peak, and it will continue to go. But we are bringing in new options. We are bringing in new industries to make up for that. Adelaide will be in transition, and there may be some turbulence, but I can't see that negatively affecting property prices enough to warrant precluding investments or reconsidering investments in Adelaide. It's something to keep in mind that we don't have that same powerhouse yet, but we need to look at whether that's something we're just going to look at in the future. Is that something which people are looking at? I would say yes. We've got a $50 billion submarine contract, which was highly politicised, but it's in Adelaide, and I would have the hazard of a guess that most of that's due to the fact of the unemployment rate in Adelaide and the talk about the economy in Adelaide. People in Adelaide may find there is a bit of a local sort of discussion about whether there's an unemployment issue. It gets politicised heavily and extrapolated in the news cycle and the like to really make it into a huge issue. So then we get the interest of politicians, of governments, of local, state, federal government. What that's meant is now we've got a submarine contract that's working quite well. It's very interesting to see how that will play out with the outer northwestern region. There is some talk about whether that will then drive prices directly adjacent to the submarine contract. There is going to be a lot of workers which will be there, and maybe transitional workers too. So something to really keep in mind around that areas around adjacent to the semaphores, Effelton, Cheltenham and the like, whether that's something which may work in its favour as a really localised market. Likewise, federal, state and local government is investing in South Australia and Adelaide across. A lot of these projects actually have funding upwards of 30 years, large infrastructure projects. A really great example of that is the Play for 2043 project. It's attempting, in my opinion, and I think the pessimist in me says, is they're trying to use this to try to push the stigma in the area out and to try to transition people from that systemic long-term unemployment to becoming employed and having the facilities there and the features that they need. Facilities and infrastructure in that, they're building large-scale commercial, multi-storey residential. They're actually building a harbour town style cross between ground level commercial and multi-level residential above. They've got plans for a 7-storey commercial building, which is quite interesting, which is apparently already had its signage already put up and getting ready for the construction period. It'll be interesting to see if government tenants are the ones getting pushed into that. The shopping precinct, which is actually owned by a trust by the Commonwealth Bank, is directly next to the main council regions there, and they've spoke candidly previously about working for joint venture for projects to actually build up the area further because they're very confident in the area. There's some of the large shopping precincts, but also this Adelaide's, I believe, the 3rd largest hospital in Adelaide, and it's getting a rapid expansion, as well as these sports facilities, which are the size of some Adelaide suburbs. Very interesting, quite a number of fields and sports. They're trying to really target the international audience, soccer stadiums and the like as well. I will try to email out everyone a link which actually shows a visual diagram of that. It may have something to play with the Elizabeth Market and how the gentrification area there. I think it might be early days before that will come into it, but it'd be interesting to see what the 20-year horizon looks like for that area. My pick, if I was to say to any investor today, I would arguably be saying, look at those inner middle ring suburbs. Something particularly if you can have renovation potential, because you are going to be negatively geared. Negative gearing is something that some may say is great, but in the end, you'd rather save $1 or make $1 and pay tax than to lose $1 and only get a percentage of that back. You're still better off. So if you can close that gap between negative gearing and being neutral, renovation is a great stopgap, which will get there. If you're looking at those inner middle rings, so those are areas directly adjacent to areas such as the Norwoods, the Unleys, the St. Peters, the Prospects of the world. If you can look at adjacent to those, the yield does jump up statistically quite high. You're talking about 20 to 30% increases in yield, but still they are negative geared, coming off very low bases of say 3%. We may be looking at 4% instead. If you can close that gap and get it to the high 4% range with a renovated property, fantastic. You're going to receive some capital growth, no doubt, from that if you've planned well and you haven't overcapitalised. The inner areas of Adelaide, traditionally, they're very small micro councils compared to other states, and they're effectively NIMBYs, if anyone's heard the term. Not in my backyard. They are very anti-development for the most part, except for the western suburbs, which has a bit of a different thing. I'll go into that separately. But the areas such as your Prospect and your St. Peters and your Norwood and your Unley generally aren't going to allow you to divide properties, even if they have an 800 square metre block, because they want to maintain the character homes, the value in the area. They don't want to push as many people in. So what you see is there's 1,000 houses in the area. In 20 years' time, there will be 1,000 houses in the area. Meanwhile, the population's grown and driven through this up and said, we want to live there. That is pushing the prices, and it has for decades, and it will continue to. what we're seeing is because the affordability of those houses are the affordability is declining, people are now looking at those suburbs next door. That example previously about Nailsworth is an example. Those people now who are looking at Nailsworth are now looking at other areas. And one of my top picks I would suggest is Broadview as an area. If you're looking in that area already, you're going to have more people looking at it, unfortunately. But to give you an idea, if you looked at Nailsworth and the growth of that, we're now seeing people transition there. Broadview's growth is already there. It's already been happening, but you're going to see more people pricing into it. We're talking about 2 streets away, but it's a different name. But that name gains its traction, gains its gentrification as people look at it as affordability-wise. The other areas I'll look at, so in the inner north, you've got Broadview, you've got your eastern suburbs such as St. Maurice directly next to your Norwoods and the like. Our office is actually in Norwood, where I'm in right now. St. Maurice is a very nice area which has seen considerable growth. So you would need to weigh up compared to those other inner middle areas, whether it's worth looking at something which may have already received 15 to 18% growth, and whether it's got much more to ride. But you've got to weigh that up. It is also the most desirable part of the whole area, the whole part of metropolitan Adelaide, and whether they're still going to get that continual flow on over time of people from those inner eastern rings, because you're talking about within 3 to 4 kilometres of the CBD. Other areas would be towards the west, the Mylands, your Torrensville, your Flims Parks. So they're within different councils, which are a lot more pro-development, but they're not allowing you to necessarily knock down every character home, every nice home in the area. They will allow some rear battleaxe / hammerhead style divisions, and you're seeing a lot more corner divisions in those areas. That's where you're getting those creative development sites. But you're also seeing the nice character homes still sitting there, which the rents are increasing considerably, the desirability is there, the growth is there. You're now starting to see that sort of yuppification of the main streets there with the cafes and the like. Be mindful that the main airport of Adelaide has a direct flight path through the western suburbs. It is very close to the CBD compared to most capitals. So you do get aircraft noise. There are some main streets you want to avoid. Look directly under the flight path. But for the most part, people do accept that the western suburbs do have flight path issues and do have flight noise issues, and they accept it. Cowandilla is very much the main area where you hit the most flight path noise. You will see prices are considerably lower. So that is one area I would probably suggest trying to avoid if possible. Down south, for the most part, the values are incredibly strong down south. If I was to be looking around those areas, I'll be looking at adjacent areas like Colonel Light Gardens, which have already had great growth. You're looking at areas such as Door Park. Door Park has some great character homes. They've got some great investments there, very close to the CBD. Got a main arterial which can take you straight up to the CBD, but considerably priced lower than their neighbours around it. So you're going to see that flow on from there. That's the main things for myself. I'd really like to get some perspective of everyone else there. We can actually run a poll. So if you look to your right, you can actually interact with this one. I'd like to see what's the main type of property investment that people are looking at. So for instance, we've got development, cash flow investing, blue chip, capital growth, balance. If you click on the right, you'll be able to actually choose from that. See if you've got a chance to do it. If you're on YouTube, you may not be able to. So we may pull this one off quickly. But I would say, as it's usually been the case, it's mainly cash flow, but we are seeing a big drive towards that balanced, the development, and even that blue chip style. So we're getting some on there, but it's really going to be most people are on the YouTube, so they're not going to be able to vote. Oh, we've got some cash flow. Almost 100%. I'd say some of the other people are most likely. Oh, we're getting a balance now, 17% development, and then balanced as well. So personally, I am looking to more towards that balanced level now. That is really where we're seeing that. But cash flow, if you've already got a portfolio with that balance or that capital growth already in it, if you've got property in Melbourne, Brisbane, Sydney, people are now looking at that option, looking at Adelaide, saying, is Adelaide an area where I can balance my portfolio? Maybe I've already got something negatively geared. Can I look to Adelaide to balance that off? That's some great statistics there, guys. So thanks for engaging with that. I'll just end that poll there. So we're looking at 50% cash flows, balancing around a little bit, and the rest got a bit of a mix there with balance being the secondary type. So I'll just end that one now. Fantastic. What we'll look at now is suburb you decide. So if anyone has any suburbs they're really interested in, jump in the chat, write it down. We'll try to go through a couple of them. We may only have time to do 2 or 3, but if you can go through them, I'd love to be able to talk through them. In the meantime, I'm happy to talk about other suburbs that we can think of. To go through just while we're waiting for people to chuck some information in there, in terms of the western suburbs, the thing to be mindful of if you are doing those developments, because we are seeing those battle axe developments and those sort of slash hammerhead, depending what state you're in. The front values are retaining well, but you generally are having to renovate the front and try to sell it into the owner-occupied market, and you're getting that second home buyer who's really buying into that, and that's where we're really seeing it. We've got the first one up, Camden Park. Camden Park's quite good, actually. We're seeing a reasonable amount of investment activity there. It's not an area which is heavily known, but it's still an area which people are looking at and saying, well, is that an area where we can get something not too far from everything, but at the same time, they're not going for that cash flow, obviously. In terms of the location, being near towards that beach is quite well. It's right near North Plympton and Plympton, so these areas have had quite a bit of the development, Plympton especially. So Camden Park's a great adjacent area where you may be able to find those corner block divisions. But for the most part, it's your mix between that balance, but you are going to need to inject some capital, do some renovations to get it there. Otherwise, you're very, very slightly negatively geared. But overall, a good option. People are pushing more and more towards beachside suburbs. I haven't really talked about them a lot today. They're worthy, to be honest, of a full podcast or a webcast themselves. But if you're looking at Camden Park, it's not right towards the beach. It's still a little bit further away, but it's still something which is going to work with you if you want a sort of a balanced investment, which is near CBD and beach. Craigmore, I own property in Craigmore. Craigmore is quite a good area in terms it has a bit of a balance. You've got to be careful of where you look, though. In terms of the lower region is ex-housing trust. You can get some very low value properties there. My first property I bought in Craigmore, I bought for, I believe, $157,000. It's worth in the low 200s now. That was only about 2.5 years ago, I believe. Towards up the hill, because Craigmore does straddle the areas around there, the hills there. If you're going into Craigmore, be careful that you need to balance whether the lower socioeconomic part of the ex-housing trust area is as good as the areas slightly up the hill, the low 200s, because the rents are going to be lower. And there is a lot of soil movement in that bottom section there, and the housing trust ones were quite poorly built. So be mindful of that. Most of them are quite fine, and you could generally find out very quickly if they do have a bit of movement around there. Let's go for a quick one. Shadow Park. Shadow Park. That's actually an interesting one. That really doesn't come up all that much. Shadow Park, for those who don't know, it's directly south of the city. It's near Hallett Cove. Affordability is not bad. Housing affordability in terms of in comparative suburbs, people are getting priced out of Hallett Cove. So it's great to look in there as an alternative because prices in Hallett Cove have stayed strong and continue to go. Shadow Park, mostly owner occupied, but you are getting still a reasonable amount of investment stock in there. Brandon, housing, I will help you with that topic. That's actually a really good one. Housing affordability program, and that does dictate to other investors. When you're looking in stock in Adelaide, investors, keep in mind you will see some which will say affordable housing program. That's a program designed by the state government selling off that housing trust stock we've talked about. Try to avoid comparing them to other stock on the market because they are generally sold for well below the actual market prices because they can only be sold to first home buyers who meet certain eligibility requirements below certain income levels, etc., and never own their first home. They're really good for investors because I've helped quite a number of younger people buy them. They renovate them, they live in them for a couple months, move out and have a great investment property they can draw equity from and get into the next one. Brandon, send me an email. I'd be happy to talk to you about that topic and how that really works. And Jeff, that's actually absolutely right. Broadview and Flinders Park, great for a PPOR. Got that renovation potential and that value add. I'll finish off with the Christie's Downs, and that will really have to much because I don't want to hold you guys up all night. But Christie's Downs, that is one of the highest ones that we're looking at for people buying in the area. Christie's Downs, right next to Christie's Beach. It's very affordable. It is quite away from the CBD, but the duplication of the freeway, it's very easy to get in. You're looking around that 30, 35 minutes on a good day, but you're also near the beach. You're talking about in that low to mid to slightly high 200, depending on the stock that you're buying. Renovations work well there, but it is still got quite a large amount of investor percentage in it. So you want to be careful not to think that you're going to get exceptional growth early on, but it will be a good steady performer just because we are seeing that investor or rental amount decline as more owner-occupiers are priced out of the adjacent suburbs. So that's really most of it tonight, guys. I won't hold you up anymore. Thank you very much for listening. It's great that you all came along, and great that you guys have got a bit of activity in the chat too. What I will be doing is I will send out a video to everyone tomorrow. You will receive a copy of this, so if you need a reference at all, definitely look at that. If you have any questions, feel free to contact info@precisionfunding.com.au. I'm happy to have a chat with any of you there. Otherwise, go to the website, you can give us a call. That's not a problem. We do provide all clients Residex reports, which will give you a lot of the suburb data and a lot of this data that we've been talking about. So feel free to email. We do it all the time for clients showing different suburbs or even specific properties. But otherwise, that really wraps it up for tonight, guys. So thank you very much for listening. Have a good night, and I hope you do find something in Adelaide which works for you.